The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst Mickey Mordick. Hi, Mickey.
Thanks, Gaurav.
With us also is analyst James Greenhouse. Hey, James.
Hey, Gaurav.
Mickey, let's begin with you this week. We've been slowly introducing coverage on some of these hot tech stocks, and there are a few that are hotter and techier than Xero, which we've actually looked at for many years, to be fair. It's not exactly a new stock for the team, but you've taken on coverage and you found some interesting quirks about it. Talk to us about why Xero is attractive to you, even though from a cursory glance it looks absolutely outrageous, the price.
Yeah, I mean, well, this is one where you have to probably, as it might be taboo to say, but kind of ignore some of the headline multiples on it. And kind of if you just focus on what this business is doing, then it's pretty clear that it's a relatively high quality company. So I guess they've got so Xero obviously provides accounting software to small, medium-sized businesses, and more over time they're transitioning towards providing tools for small and medium businesses, so less of an accounting focus, I guess, but that's their bread and butter, I guess, so to speak. And there's a couple of reasons that they've been so successful so far. Obviously everyone's probably well aware of the shift to the cloud. They were the first to make that shift, and obviously that provides a lot of benefits in terms of giving people access, from home, and greater affordability of the platform and things like that. More updates.
You see that all the time, really. You see all the time whenever something industry changes, it's rare that the incumbent leaders initiate and take advantage of that change. It's usually an external company that comes in and takes the opportunity, and that's definitely what's happened here. Xero came from nowhere, this tiny little New Zealand startup, and it took on these multi-billion-dollar giants and killed some of them.
Yeah, absolutely. I mean, if you look at the incentives, I guess for some of these bigger companies, they would have had to have disrupted their own business model, basically. So the incentive just wasn't there, and I guess as you get bigger, you're not quite as nimble. Maybe you're more focused on growing profits as opposed to looking at new ideas and new ways to disrupt yourself. So
it's also just hard. I mean, in technology, perhaps more than in almost any other sector, to be the incumbent is to have inherent disadvantages embedded, because you have to use old technology. You have processes and systems in place that were built to handle old technology. So when something new happens, you're just not built for it. And you see this in the car industry with electrification. The existing car makers aren't optimized for building electric vehicles, and that's why they've been so slow and so far behind Tesla. But I digress. Let's get back to Xero. So what were you saying, Mickey? Where were you?
Until I was so rudely
interrupted. Yeah.
Xero. So they made that shift to the cloud, and then obviously that gave them a big advantage in terms of being able to provide updates more regularly for the software. And they also provided a platform that was open for third-party developers, and so that attracted a lot of third parties to the software to make the platform better, and that provides a bit of an ongoing of positive kind of feedback loop there, because as they make the platform better, that attracts more users, and then more developers want to work on that platform.
So it becomes a lot stickier, doesn't it? Because people are already embedded their own systems into Xero, and so therefore it actually makes it is a true platform business, is what we talk about when we talk about platform businesses. They sort of embed other sort of programs within them, and then become useful and very almost impossible to let go of for everyone who's involved in the platform.
For sure.
And everyone's trying to be a platform, and this is one business that's morphed from software to platform successfully, probably better than anyone else.
Yeah. I think like more and more what you're probably seeing in software is just that the software is actually less valuable than building a platform. If you can build the platform and encourage people to build on top of your platform, that provides a whole new level of stickiness than just having a piece of software that you can sell. Even though software in and of itself is quite generally quite a sticky business, like people get used to the software and changing programs and moving your data across and things like that, or just knowing how to use a program. Once you add on a whole bunch of apps and things like that as well, and just make the platform better, you get really good economics. So what you're seeing now for Xero is they're really trying to push hard on that platform lever, and that's growing really quickly. So revenue there I think grew. I think they just came out with their half-year results. It was up 110% or something like that.
So these actual, they're selling. Are they actually getting revenue from other business customers? Is that what you're talking about?
Yeah. So
Okay.
so third-party businesses, say for example, if you're a plumber or you're a tradesman or something, and you want to have book in your jobs at the same time, or do invoicing through the Xero platform, for example, there'll be very, very niche kind of industry-specific functions that you'd like, and so these developers come in and they just enrich the platform or the software by adding more features, making it more kind of customized to that particular industry. And so that provides revenue for both Xero and for that third-party developer. And then so this is the kind of revenue line that for Xero should hopefully grow over time. If you look at, I think Salesforce, for example, they generate about nearly a fifth of their revenue from the platform.
Jeez, is that right?
Yeah, I think it's 15 to 20%, something like that. And so Xero is still like 5% or something. So there's quite a bit of runway potentially grow that platform revenue. And just I think that's the main strategic focus for now.
I reckon the real attraction of Xero, though, I think the reason we've looked at it a few times, perhaps more than any other of the wax stocks, is the revenue recognition and the accounting actually deliberately hide how profitable this business is, and some of the discretionary decisions of management hide how profitable that business is. So the PEs look absurd, but Mickey, explain to us why we should not rely on those PEs to form a judgment on value.
Yeah, so well, I mean, it depends on the way that you look at the business. But I mean, traditionally, from an accounting sense, if you're spending money on sales and marketing, that is expense that just gets run through your profit and loss. But what happens in Xero's case is they keep their customers for a really long time, on average. So across the whole customer base, it's I think 7 years. But if you look at just Australia and New Zealand, it's probably more than double that. And so you can say, well, they're spending X amount on acquiring a customer, but actually that all gets expensed in the first period. But then if you expense that over the whole customer lifetime, you probably get a better idea of how profitable it is. But yeah, I wonder if...
Let's unpack that a little. This is a really key point about Xero, and I'm not sure it's all that well understood. So let's say a customer comes on board. To get a customer on board might cost you, I'm using just wild numbers here, might cost you $30 or so. And you'd expense that $30 up front, and you collect maybe in the first year, let's say $10, or in the first month, sorry, $10 for that customer. So your accounting entries in the first month, you're down $20 because you're only collecting $10 and you're expensing $30. So you actually have to wait to build revenue stream. It takes time to realize profitability in this business, and if you're only looking at valuation at a point in time, it's completely misleading, which is what is so attractive about a company like this to value hounds.
Yeah. So now you, I mean, it's if you could have seen that, I suppose,
Yes,
4 or 5 years
that's the
ago,
thing. If you could see,
it would have been the perfect time to
but
have.
they were the first SaaS
yeah.
company. It's really a mind warping experience to try and analyze a SaaS business without having a lot of experience with SaaS businesses. It's taken them and others to sort of educate the market about how to do it properly.
Yeah. So I guess you've got to pay really close attention to those unit economics. What's driving those? So then those things like how long they keep a customer for, what are the average profits that they make per customer, and looking closely at those, and comparing that to the cost of actually acquiring those customers. And generally, if the lifetime value of your customer is a lot higher than that cost of acquisition, then it makes sense to keep spending money to keep going out. So, but you'll get a really ugly looking financial statement. So, yeah.
So we like the business. We can understand that valuation may mislead, and there's actually a lot more profitability than it looks like. So why is this still not on the buy list, and why are we still cautious about it, Mickey?
Well, I mean, it's so although it you can't take the numbers at face value, it still looks pretty expensive, and I think there's some optimistic assumptions definitely priced in for now. So it's got a really big competitor in the US in Intuit, and Intuit's more than double the size of Xero, and they've done a great job of building their own online product as well, and so the US market makes up a little over a third, I believe, of kind of the English-speaking addressable market. So it's going to be a tough nut to crack. The US, definitely with QuickBooks fighting so hard there. Given those risks, it's probably not growing fast enough in the US. But I mean, it certainly looks like a very strong business, and like if I was owning it, I wouldn't sell it or anything like that. But
the thing I want to say to members, though, is there's been a management diktat for us to cover these in the WAC stocks. So we've covered WiseTech and Xero, and to me, Xero is undoubtedly far and away the best of any of the WAC stocks, and the others I think are generally probably rubbish. But Xero is a good one. But as a member, you don't need to buy any of these stocks to have a good portfolio. I mean, we all look at them and think, yeah, they're good businesses, they've done well, and you're naturally attracted to businesses or to companies or stocks that have gone up a long way. But the reality is you don't need to chase these stocks. You don't need to buy these companies. I mean, Xero is now has a $10 billion market cap. It is not a small company. It's got a lot into the price, and so you can ignore them. You can actually look for other opportunities, and so while we want to understand the business and the economics and so on to see how this might work for this company or for other companies in the future, you don't need to worry about having missed out on Xero. There'll be another stock along in the future.
I think as a full-time investor, one of the hardest things to do is to sit back with your experience and your caution and your judgment, and not to partake in rampant profit taking that everyone else is partaking in. I found this whole wax experience quite difficult because I agree with you, James. Especially, I think it's clear that Xero and perhaps Altium are the best out of that bunch, and some of them are rubbish. And I would arguably put WiseTech perhaps in that, and I think Appen is. I don't even understand how that's on that valuation. It's crazy to me.
Yeah, rubbish. They're both of them.
Yeah. Look at us, two grumpy old men. But it's been really difficult just to hang back and to stick to your own judgment and to stick to your own strategy while, I'll say it, the fools are all making money.
That's right, exactly. It feels embarrassing to miss these things.
Yeah.
But we need to just let that go. And you, as an investor, you just need to suck it up and say, look, I'll look for the next opportunity.
And it's a reminder that successful investing is more about behavior and psychology than it is about analysis.
Yep.
If you can get that bit right, you don't have to get all the analysis right all the time.
Yep.
And I think that's what we increasingly strive to get right. I think the analysis part, and it's actually is the easier part. It's the behavioral stuff, especially when you apply it to a scenario like this. That's hard to master. But Mickey, you've mastered it very nicely indeed. It was a cracking article. I think we read the first 2 paragraphs, and everyone in the office turned to you and said, "Nice one." So I'll repeat that again. That was a cracking article. If you haven't read it, Mickey's Xero article's up and definitely worth a read. James, you've been looking at another former market darling, Freedom
still
Foods.
a market darling, actually.
Is it still, really?
I think so, yes.
All right. Well, let's discuss this a little bit, because I found this curious as well. Because for me, this has all the hallmarks of a business I wouldn't really want to get involved with. But it has been a hot stock for a while. I thought it had fallen off that hot stock perch, but apparently not. Tell us about Freedom Foods and why you even bothered to look at it.
Well, I was told to. But
What did you find?
Yeah, it wasn't. I mean, when I first looked at it, I thought, yeah, this is not the sort of company I'd be interested in. It's sort of fairly capital intensive, and the more I looked at it, the more I thought that is the case. So Freedom Foods is, as you can imagine, it's a food company. It started off in gluten-free cereals and those sort of products, and it actually did quite well. And it's in the health space, so that's naturally quite a positive space to be in the food sector. It's growing faster than other sectors, obviously. But what Freedom Foods has been doing for the past 4 or 5 years is building a lot of new factories and entering a lot of new markets. And they're probably their fastest growing 2 divisions. And there is not the cereals division anymore, but the first fastest growing division is the dairy and nutritionals segment. So that's they're basically the largest UHT milk processor in Australia. They've built
the largest.
Yeah.
Oh, okay.
So they source milk and then ultra heat treat it, and then obviously sell it to Coles and Woolworths. But they're also got a fairly big business now selling into China, and also Southeast Asia. So they've sort of jumped on the bandwagon is maybe the wrong way to put it, but they've jumped on the bandwagon of selling.
But you put it anyway.
Yeah, I will. Dairy products into China, because I mean that is where some of the growth is coming from. And the other business that they're also is growing quite fast is their plant-based beverages division, and that you might remember. I mean, soy milk has sort of been around for a long time. It sort of has a reputation of sort of hippies and vegans and vegetarians and so on. And I used to drink it, and now it's actually soy milk is now it's lost a bit of favour with the market, and now it's more about the sort of the almond milks and the pea milks and all those sort of
Almond
things.
milk. Have you ever tried almond milk?
No.
Almond milk is basically water and sugar with a tiny bit of crushed up almond in it.
That's exactly what it is.
Yeah.
It's 2% almonds.
2% almonds. Yeah, it's the biggest rort.
Yeah.
I actually noticed that the other day with some butter.
What happened to butter?
Yeah,
I
well,
love butter.
you know the butter that comes in the package, and it says contains butter, and when you look at it, it's it was like 30% butter.
I tell
So
you what,
got to look at the package of the butter.
You should always go premium butter. Butter is one thing that life is too short to go with cheap butter.
Yeah.
You should try that Danish stuff. That is great.
Oh, okay,
Yeah,
cool.
Sorry, we're digressing again once more.
I can't believe it's butter. So they're the 2 main divisions for Freedom: is the plant-based beverages and the dairy, and they're growing really, really fast. There's no doubt that what's happening is as the factories are maturing and ramping up, and the products are maturing, they're actually selling more products. So their sales are rising, their earnings are rising quite fast, but they've spent a lot of money to get there. And this is where it falls down for me, is they've spent $170 million last year and about $500 million in total over the past four or 5 years.
Extraordinary.
So it's a
Wow.
lot of money.
How have they funded that?
This is the thing, when I looked at this company, they've had an equity raising every single year for the past 4 years.
Wow.
And so I mean that money's coming from shareholders' pockets.
Yep.
And yeah, you can effectively buy growth that way by spending money, but you've then got to make sure it is actually going to turn up as earnings, and more importantly, free cash flow down the track. And that's what worries me, is that especially for a food company, you can't just develop a product and then forget about it.
Yep.
You need to keep pushing it. You need to develop new products. As they've seen, their soy milk product is falling away, and now it's all about almond milks and pea milks and milks that don't split in coffee, and they're the ones.
Pea milk just has a really bad sounding ring to it. Actually, let's not mention that one again.
It seems like that space though is attracting so much capital at the moment, just
Yeah.
in general. Like it seems
Yeah.
like a really in favor kind of area. And
That's right.
Yeah.
And that's what worries me, is I perhaps think this company might be chasing the sort of fad foods.
Yeah.
And that's what worries me, that, in 4 or 5 years that might change. They'll need to develop something else. And then they've got to build another factory out at Shepparton to manufacture these things. So it just doesn't strike me as really the best sort of business in the world. And you can purchase growth, and that's what they're effectively doing, I think, by putting all this money into factories. But yeah, it doesn't really strike me as a great business.
No, I would agree with that. The thing that concerns me, actually, very similar to you, James, is when a business goes off and sinks a whole bunch of capital, but the returns are coming from a competitive industry with unknowable demand that's dominated by fads and fashions and lots of competition. It seems like a recipe for me just to sink a lot of capital for an unknowable and likely low return. And it's a really unattractive prospect. The one saving grace about this company, though, James, is it is an owner-operator. The same family's been in control for a long time, and that does fill one with a bit of comfort.
Yes.
if that's what you're looking for.
That's right, and I mean that's one of the reasons why I think that that it was asked for me to have a look at it, because I think it is an owner-managed company, and generally, they're not going to spend capital
That's right.
with the idea of blowing it up. But who knows what their end game is? I mean, the thing is, they may be intending to sell the business. They'll ramp it up and then sell it maybe, and they're also the family that owns 52% of this company also is a supplier to the company as well. So there are some related party issues, and so there's other sort of things going on there that may mean why whether it's owner managed or not may not make much difference.
Can I quickly ask you about that milk processing business? Is it a big advantage to be the largest in Australia, and does the scale lock out competitors? It seems to me that's yes, there's a lot of capital being poured into there, but it's not difficult to replicate, and it's likely to attract competition should margins ever get high enough.
I absolutely agree. I mean, this company has raised $500 million without any problem at all.
Yeah.
And so clearly, that capital is there for other companies should they wish to do it. And we all know that the dairy sector is pretty hot, and it's been hot in here and supplying to China as well. So there's capital available for that. And and don't forget, New Zealand is a big dairy market as well.
The
so
biggest.
It's not, so it's not like Australia is the only game in town here.
Yep.
So you're right. While I think it's currently sort of a hot segment, and people want to buy milk products, and people in China want to buy milk products, and that probably will continue. But as you say, Gaurav, there's no real barrier to entry here, and capital is not really a barrier to entry in these things necessarily, and some other companies will be, and there are plenty of other dairy companies out there who are investing in facilities and taking advantage of good prices, which are current at the moment but may not be there forever.
I've just started taking a look at A2 Milk, just in the early stages. I've got lots of other interesting stuff on my plate, but A2 Milk is one of them. And it was interesting to compare, I think it's called Milk Lab, the Freedom Foods version.
Yes.
Milk Lab with A2 Milk. It's just, Milk Lab seems like it's just a hodgepodge of different bits and pieces put together with the hope of trying to find a new hit product. Whereas A2 Milk is a really focused competitor who know exactly what they're doing. They have one strategy and one plan, and they don't own assets. They understand that they're a marketing business, and the returns are incredible. It just seems like a much more nimble and ferocious competitor, whereas Milk Lab, to me, seems like a lumbering conglomerate that really doesn't have a clear plan.
Sorry. I mean, Milk Lab is a division of
yes,
Freedom. That's right.
That's right,
yes, I mean, exactly right. And that was one of my concerns as well, is that Freedom Foods, it's not focused, and it has extraneous divisions. It has a specialty seafood division, and maybe they'll get rid of those in time. But it just
that would be a big signal if they did that,
and certainly if they focused down to maybe those two best divisions, and just simplified their business a bit. But it's a very complicated business. Lots of different customers, lots of different markets, and still a big supplier to Coles and Woolworths, which is and they're not known for letting their suppliers earn high returns.
I think that's a really good point as well. People forget that these kind of businesses are really captive to these two companies, and how many suppliers have ever made decent returns supplying Coles and Woolies? A lot of people thought Costa was one, and it clearly isn't. I can't even think of any. I cannot think of any business that's made fantastic returns supplying the two giants, and I don't think that's going to change.
No.
Wow, that was thoroughly strucken from the list. Mickey, do you want to add any love for Freedom Foods?
No, it sounds like a tough business, and building consumer brands is hard work. But I mean, it's probably easier now than it was. But staying at the top is probably also harder. So
I think we need to acknowledge. Maybe I've been quite critical of the company, but I think you're right there, Mickey. Is that building consumer brands is hard, but there are some potentially interesting brands within this company. I think Milk Lab was one of the ones I mentioned. So it's not out of the question that this company could have some pretty amazing products and make some pretty good money. And so we're not saying this won't be. It's currently a $1.5 billion market cap. It could be a $3 billion market cap in a few years if they get some of those things right. But it just doesn't seem the sort of business I would want to hold for the long term.
Gents, a lot of people are complaining that there's not many ideas on the market. We're certainly, I think anecdotally, working a little bit harder to find ideas. But something that has popped up recently, JG, we've both written articles about forthcoming potential splits. I've covered off on Iluka and the potential split of the royalty business, and you've covered off on Grain Corp and the potential split of the malt business. And both of those are non-conventional ideas, but what they share is this notion that a demerger can often be an attractive opportunity. Just explain to us where this idea comes from and why it's so beloved by us and by other value investors.
Yeah, I'll admit that I'm sort of, I think,
Yeah, I am too.
biased towards demergers, and
Definitely.
I need to be aware that not all are wonderful. But I think the thing about demerged businesses, and I might use Maltco, the Grain Corp business, as an example, is that I think Maltco, the thing is that business has been stuck within a very, very poor performing company, which is Grain Corp, for quite a long time. And so what happens is, first of all, it means the market doesn't have a good idea of the underlying economics and sort of the way that business operates. But second of all, it also means that it probably hasn't had the best management focus. So they're for me the two things that make you think, as a separate business, it could actually be a much better opportunity. And I think that sort of is borne out, because even when you read the demerger documents that any company releases before a demerger, there's usually not that much information on the demerged business. It's not like an IPO. You don't get as much information. So it's not until that company's been listed for a year or two that you sort of learn how that business operates and what are the strengths and weaknesses. And particularly why I like Maltco is because Grain Corp's current management, including both the chairman and the CEO, are basically dropping Grain Corp and moving across to the malt business.
That's very telling.
To me, that is probably the biggest sign that this could be a really, really good opportunity. So they're the main reasons, I think, why in that case this demerger could be a good one, and that's why I've written a couple of articles on it now and just telling people, look, watch out for this. We think it's potentially coming. There could be a couple of upsets in the meantime, but we're definitely watching it. So I think demergers are often a good opportunity, and hopefully this will be one.
Yeah, the other thing with demergers is that the market in general hasn't focused on this new business. They haven't built relationships with the management. They haven't been following it. So there can be a bit of information asymmetry there, and I think I can see that in Maltco, where the broker consensus is very low, very different to your sort of thinking about the business. And I saw this with South 32 as well, where broker consensus was way off our internal estimates of the value of that business. I think there is a genuine opportunity for an informational edge in demergers that just is not present in other parts of the market. And then once a business actually splits, you end up with a really dislocated shareholder base. People wake up one morning and find themselves owning a stub that they'd never wanted to own, never thought they bought, and don't really want to keep. And so you end up, I think post the merger is a really interesting time for demerged businesses. You often get quite thoughtless selling, and there's a good chance of picking up a bargain in that circumstance as well.
And sometimes even management talks it down. And we saw that with Coles. And Coles has turned out to be not as great an opportunity as I thought it would be.
Although the performance, share price performance has been really good.
Share price done okay, but the management were actively talking that business down around about the time their incentives were being set. And it was just pretty clear. So it was sort of quite interesting how, and now there's been all this information coming out, we're doing cost cuts and so on. So you're right, in that sort of initial period, especially watch out when management's incentives are priced. They'll probably be talking that business down.
Mickey, your thoughts on demergers? Ever bought into one?
I think that's most of the reasons. I guess they also have management tend to have an incentive to make sure the new entity is well capitalized as well, and because obviously it's going to current shareholders, so they don't want to screw them over or anything. So I guess it gets a bit of potential for new investment within the business as well. But I think that it's fertile ground for sure.
Yeah. In Iluka's case, Iluka is a mineral sands producer. They own almost 30% of the global mineral sands business, a multi-billion-dollar business, and they've never consistently made decent returns. So it's a pretty crappy business, despite having notional dominance. But within that company is this money-printing machine that just has a royalty from a large chunk of BHP's iron ore operations. BHP has 4 basic hubs in iron ore, and one of those hubs has to pay a royalty to Iluka for every ton of iron ore it mines, and it's linked to volume and price. So it's a really reliable source of income that costs nothing. It's free money. It's one of the best little businesses I've actually seen. So to be able to get access to that royalty, I just think it would attract a different shareholder. It would attract much higher prices than what's currently embedded into Iluka. So the opportunity to free that up, I think, will generate a lot of value. So
it's going to be quite hard to value because it depends on prices, but it also depends on. I think you mentioned there's a big upgrade of the mine or the facility.
Yeah, the source of the royalty is going to be expanded.
Yeah,
and that's actually triggering this review of the royalty, because it will end up being the majority of Iluka's business. And shareholders in Iluka are there because they have a view on mineral sands or they want exposure to mineral sands. No one is adequately valuing this royalty, but they will post the split. So I think this makes it's actually a very similar situation to GrainCorp. You've got a lousy parent business potentially spinning off a really interesting stub, and that could be a source of opportunity. So we're just keeping an eye on these two, but just wanted to get the message out generally that these demergers are really interesting, and we will almost always look at a demerger opportunity, and I think everyone listening should give it some thought as well. These are reliable sources of advantage that don't pop up all the time. Gentlemen, we're all nodding along, but I think it's time to end this. Mickey, thanks very much for your time today.
Thanks, Gaurav.
JG, thank you for joining me.
Thanks, Gaurav. Thanks, Mickey.
And for everyone else, thank you for listening.